Hi everyone, it's Lisa Wells over at Waterstone Mortgage. I'm sending out this video today, and our topic, keeping in line with our educational series that we started last month, is about ARMs, adjustable rate mortgages. And the reason that we're talking about this is because when we pulled you guys who are our pre-qualified clients out looking at properties, getting ready to really make that plunge into getting a mortgage, this was your number 2 biggest question that you asked. Why an ARM? When an ARM? How do they work? Why should I be looking at them? So, a couple of quick questions. People should look at ARMs if they think that they are going to be in the home for a window of time. ARMs are fixed for a period of time. If I give you a 3-year ARM, it's fixed for 3 years. If I give you a 5-year ARM, it is fixed for 5 years, 7-year, and 10-year subsequently. After that fixed period of time, it then becomes variable once per year thereafter. I think the hard part about ARMs is that they got a really bad rap a few years ago. Those were not the ARMs that we do today. The ARMs that got a bad rap a few years ago were 2-year ARMs that allowed people to get in with maybe more challenged credit, and they allowed them to do interest only for the first 2 years, and that interest rate would change after the second year, and it would really have no chance of going down. It would only go up. And so for those folks that did it, it was kind of the double whammy of all of a sudden after 2 years being able to pay interest only and then having to pay interest and principal plus having the interest rate adjust. Those kind of ARMs are no longer in our marketplace. So the ARMs that we have today, I feel are really good, viable options. And I know interest rates are, yes, going to go up. We all know that. But if we are in a property that we know we're only going to be in for 5-6 years, does it matter if the interest rate goes up after year 7 if we think we're going to be gone in year 5 or 6? No. So that's why ARMs are attractive. The other thing is that interest rates are lower on ARMs. Right now, the spread between a 30-year fixed and a ARM could be anywhere from 1.25 to about 3/4 to 5/8 of a point less on an adjustable rate mortgage. So it does help people qualify. It does help people get that lower monthly payment in the early years of that mortgage. So again, after that fixed period of time, the world doesn't end. So many people think, oh my God, I got to pay the mortgage off. It does not balloon. It simply will take into account what is happening with the current mortgage, current interest rates, and it has some caps on it, which means we've put in place parameters that your mortgage cannot adjust to. Average caps on a mortgage, the low end would be 2.25, and the high end would be 5% above the start rate. Those are the caps that your interest rate can move around in on an annual basis after the fixed period of time. So again, it's one of those things where there are parameters that if you are thinking, hey, I'm not going to be here long term, this is my first house, I don't know where I'm going to be in 7+ years, definitely take a look at ARMs. They are out there for this very reason, so that clients have some different options. I mean, I hate to see people do a 30-year fixed mortgage when even now the average length of a mortgage is about 6.9 years. People use their mortgages more, they move, they refinance, they adjust accordingly. So again, this is just the tip of the iceberg on ARMs, and we can definitely talk about them in more detail if you have questions on them. But I wanted to get the information out because, again, this is your second most requested question item in the world of mortgage. So again, I hope this was helpful for you, gave you some insight, gave you some thinking points. And if there's anything that you guys need or anything that we can do for you, please don't hesitate to give a call. Thanks and happy house hunting.